Hello, I'm Angela Palacios, Partner and Director of Investments here at the Center for Financial Planning. Later, you'll hear from Jacqueline Jackson, Portfolio Manager, and Nick Boguth, Portfolio Administrator. 2021 has really been a story of rotation for markets. In 2020, two of the worst sectors, energy and financials, have become the best performing sectors so far in 2021. If you looked at your December 31st statement and made changes based solely on past return, you would have missed significant gains, an old but good lesson that past performance isn't necessarily indicative of future returns. Last year, technology benefited the most from the pandemic as people shopped from home, worked from home, looked for entertainment from home. This year, markets have been influenced heavily by the deployment of vaccinations and hope that we can return to normal very soon. Speaking of vaccines, the share of people who have gotten the vaccine is on the rise and getting better every day. This reduces the risk that a hiccup in vaccine deployment could cause market volatility, so one less thing to keep me awake at night. In Michigan, as of Monday, April 5th, people as young as 16 years old can register for an appointment, and these numbers are improving every week. Year to date, through April 1st, a diversified portfolio made up of 40% S&P 500 index, 20% MSCI EFA index, and 40% Barclays US Aggregate Bond Index is up about 2.4%, showing a nice start for the year. The Federal Reserve has reiterated that they're not even thinking about raising interest rates yet, according to the chair, Jerome Powell. Despite that, the market has pushed long-term rates higher, pricing in actually several rate increases before the end of 2023, despite the Fed chair's messaging. This created a challenging return environment to longer-dated bonds, but results in a more attractive interest rate environment today than we have witnessed in a little while. Inflation still remains muted, although we're seeing small pockets of it due to supply chain disruptions. There's really a lack of velocity of money that continues to be a headwind, and kind of the main reason we haven't seen inflation pick up substantially. As long as banks don't have a large incentive to loan money via high interest rates, inflation may continue to be muted. The American Rescue Plan Act of 2021 was signed into law this past quarter. This resulted in stimulus checks to the public. The additional $1,400 stimulus checks started getting delivered the week of March 17th. It's likely that consumers will spend these checks, as we saw spending on goods in this chart. The orange bar on the chart increased in January following the $600 checks arriving in late December and early January. I expect we'll see another temporary spike in consumer spending for March and April. President Biden hasn't wasted any time turning attention to the next stimulus plan in the form of the infrastructure bill. It is likely this bill will not get passed unless mostly paid for by other means than deficit financing. Bargaining on tax hikes has already started in Washington, at least behind the scenes. Jacqueline is going to give us some perspective on stock market returns and tax rate increases.
Hi, everyone. Many are wondering how the Biden administration's tax reform will impact the stock market. Economists estimate a 28% tax rate will result in a 9% corporate earnings decrease in 2022. However, before we jump to any conclusions, let's consider a few things. I have 3 ideas I want to share with you to help navigate this situation. There are other ideas in the blog, so feel free to read the blog as well. The first idea, tax reform has to go through Congress. So here's the deal. Most economists don't believe a 28% tax reform is realistic. Most believe a 25% tax rate is more realistic. That results in a 3 to 4% corporate earnings clip. That's much more modest than what many people fear. The second thing to consider, tax reform may not thwart economic growth. Based on what Biden has said in the past, some of the spending from tax increases will go towards infrastructure. Infrastructure spending generally expands the economy. So actually, this type of spending may help to balance any impacts of tax rate increases. The third and most important thing to consider is that historically, there isn't much correlation between stock market returns and tax reform. The S&P 500 has gone up when tax rates decrease. The S&P 500 has also gone up when tax rates increase. Clearly, there is opportunity for you to meet your investment goals, no matter the tax policy. So, investors definitely need to stay the course and keep their investment discipline. Here's the key takeaway. Do not be afraid of tax reform. There's room for you to continue to meet your investment goals. And remember, the center is here to help you develop tax strategies to help you through any tax environment. Thank you.
SPACs, or Special Purpose Acquisition Companies, raised more money last quarter than they did in all of 2020. This is even more jaw-dropping when we realize that in 2020, they raised more money than the previous 10 years combined. If you haven't heard of SPACs yet, they are public shell companies created with the purpose to go merge with a private company and bring it to the public market. This can be beneficial to the creators and sponsors of the SPAC because they get paid substantial fees, including a large stake in the target company. Private companies that want to go public may benefit by merging with a SPAC because it is much faster than the traditional IPO or initial public offering process. But do you, the investor, benefit by investing in a SPAC? That depends. They're definitely not for everybody, as they are very high risk, high reward investments. Their performance numbers since just last year range from a whopping positive 300% or more, all the way down to negative 75% or worse. And those are just the completed SPACs. Many SPACs never find a private company to merge with, leaving you right back to where you started, and potentially missing out on returns from being invested elsewhere.
We continue to watch current events and how this will affect markets and you, our clients. Our goal is to keep you updated and make course corrections to your financial plan and your investments as needed. If you ever have questions you would like us to address, please don't hesitate to reach out. And thank you for watching.